In about a month, the USDA will release its updated forecast for U.S. net farm income in 2016. Its current projection is about 56% below the high reached in 2013 and 3% lower than last year. To learn about the impacts of tighter, if not negative, margins over a sustained period of time, we talked last week with Brent Gloy. Brent is a visiting professor at Purdue and currently operates his family farm in southwest Nebraska. Along with Purdue ag economist David Widmar, Brent writes for ageconomist.com. To start our discussion about the overall health of the ag economy, we asked about how lower returns were affecting producers.
We're really in the midst of what I would say is the biggest downturn in farm economics that we've seen probably in most our lives anyway. And I think the signs are starting to show throughout, for everything from capital investment to farmland values to just a little bit of financial stress starting to rear its head. So, this is kind of 3 years of a downturn. We're looking at maybe another. So things are starting to get pretty tough out here in farm country now.
Let's talk about some of the costs. Let's start with fixed costs. And I had watched a video you did from about a year ago talking about the importance of keeping an eye on fixed costs and controlling them if margins were going to be tight. Tell me what role they play in the budget.
Right. When you look at where farmers spend their money, you got about 40%, I call it 60-40 rule. About 40% of your expenses are variable expenses and 60% are fixed. And everybody always, your first inclination is to manage the 40% variable costs. And there's nothing wrong with that, but we can't ignore that 60%. And in the downturn like this, the reality is that 60% has to come down. So cash rents, land values, machinery investment, those things are starting to come down, but they're very reluctant to do so.
Yeah, tell me more about whether or not they're coming down, in which areas they're coming down.
I think the data we see now coming in from the University of Nebraska, Iowa State, other areas, Kansas City Fed, Chicago Fed, all point to lower farmland values. I mean, maybe 8% down in Iowa, another 6 or 7 this year. Nebraska's starting to show some declines. So land values are starting to react downward. And it's not that that's a good thing. I like to see land values really high too, because it means the economy is really going along. But in this time period, that's where the pressure really is. And we're starting to see that happen.
Are there signs that variable costs are coming down at all?
Yeah, variable costs, actually this year we saw the first time where we started to really see some improvement in cost structure, particularly with fertilizer prices this year, down maybe 15 to 20% this year. And so I think that's a good sign. We're starting to see those costs react, and people's cost structure is getting better. Unfortunately, the prices keep getting worse. And so we're still going to have work to do. We had quite a bit of savings on fuel this year, and as I said, fertilizer, and I think we're going to continue probably to see some pressure on those variable costs to come down.
There has been so much focus on interest rates and the Fed's decision to not move those rates. We've talked about it from an export perspective and the strength of the dollar, but to the farmer on the operation, how much impact is there?
Yeah, interest rates have been one of those things that, boy, they get a lot of attention, and in part because it seemed like forever since they actually went up. Farm level interest rates are still really, really low, and that's a good thing supporting agriculture. I don't think even 1 or 2% increase, 100-200 basis points, is not going to blow a hole through a lot of people's budgets on the operating side. The thing where they're really important is underpinning the land market. These low interest rates help support farmland values, and so we want to pay a lot of attention to it. But in the short term, long-term interest rates are as low as they've been, and they continue to provide support to our farmland market. So something to really keep an eye on, but right now they're not moving much, and even though every economist has been saying for the past 5 years they're going up, they still seem to be hanging in there pretty low.
You just finished wheat harvest here, and you've done some work on your site about overall wheat acres. Tell me about the future for wheat.
Yeah, wheat, the economics of wheat are really tough right now. We're looking at cash prices around $3 a bushel. I just scanned UNL's crop budgets this morning. They show cash costs. I think the lowest cash cost they showed was somewhere around $3.30, and total costs range from everywhere from like $5.15 to over $7. So wheat is just not really very attractive crop right now. And we've seen over the last 30 years, tremendous amount of acres go out of wheat production. The statistic David came up with that I thought was really interesting, 800,000 acres a year decline in wheat over the last 30 years. To put that in perspective, Kansas grew about 8.5 million acres of wheat last year. So in other words, every 10 years we've lost a wheat production area the size of Kansas. That's kind of crazy to think about how big that decline has been. But unless economics improve in wheat, I think we're still going to struggle to keep wheat in production.
I know we're early, but what does the outlook look like for 2017?
Yeah, 2017 is bearing down on us, even though we're a long ways from even harvesting this crop, but people are already starting to do some planning. And when we look at the budgets, it's looking pretty tough, I think, for 2017. Again, another year of intense pressure on costs. Fertilizer prices, it's going to be really interesting because we had a lot more acres of corn planted this year. Corn is very fertilizer intensive. We'll have to watch and see where that goes. Right now, they seem a little soft, but I wouldn't expect to see the kinds of declines we saw last year in fertilizer. More pressure on equipment, more pressure on land values, but the budgets, again, are not looking great for next year, so I'd look for intense pressure on cash rents and other things.
Anything farmers should do actively to make sure they're staying ahead of the game here?
Absolutely. I mean, crunch your numbers, understand your financial position. We're in the third year of this downturn. It's looking like another year's coming with these big commodity crops we're growing. Commodity prices don't look so good. It's really important to stay on top of where you're at on your finances, understand your cost of production. So when you get a chance to market crops at prices above your cost of production, it's a good opportunity to take that. But you can't do it if you don't know where your costs are at. So spend some time with your finances, spend some time with your lenders is really important in this environment.
You can read more from Brent online at ageconomist.com. His most recent post details falling net farm incomes.